Thank you for coming along to this session. My name is Bronwen Jones. I am a partner at Reed Smith in London. I spent most of my life looking after fund finance transactions for both lenders and for funds, although not usually on the same transaction. I'll just let the panel introduce themselves. So working along from me, Jorn, if you want to introduce yourself.
Yeah, Jan Pelzer. I'm a partner at Pinova Capital. We are actually a fund based in Munich, focusing on Mittelstands transaction in the technology space, industrial tech and information tech, everything above 10 million in revenues. I founded the firm in 2007.
Thank you. Mirza.
Mirza Mulic, director in the fund finance team at HSBC Innovation Bank. We are providing financing solutions for funds from capital call lines, GP facilities, NAV facilities to support clients from day one until later in the fund's life.
Thank you. And Dirk?
Dirk Flor, a partner in the banking and finance department of Reed Smith in Frankfurt. I advise on different types of lending transactions, in particular also on fund finance, which will be the subject of today's panel.
Thank you. We're going to kick off with talking about subscription line financings, also called capital call financings, or bridging facilities. They're the most common fund finance that we see. And just by way of a very brief background, they are normally facilities provided to a fund, and the recourse for the lenders to that fund are to the uncalled capital of the investors in that fund. So they will have security over that uncalled capital. So they've existed in America and in Europe and the UK for a long time, but Dirk, I gather they're not yet quite so common in Germany, subline facilities.
Well, I mean, they're becoming more and more common also now in Germany. I mean, we're working now on fund finance products subject to German law for about 8-9 years. But before the time, it's actually true, PE funds and VC funds, they were very reluctant to take out capital call facilities. And the reason was a pronouncement by the German Ministry of Finance, and basically this, that's not simplified, but this pronouncement basically said if a fund takes out a financing on the fund level, then this can have very severe negative impacts from a tax perspective on the investors. And therefore, funds in Germany were very reluctant to take out capital call facilities for many, many years. But now fund counsel, i.e. the advisors of the PE funds, of the VC funds, become more and more comfortable with it, and they've also found structures and clauses that we then use in the facility agreement that gives them comfort that they can sign off on those transactions and that those transactions don't have those negative tax implications.
Thank you for that. It's good to hear that fund financing is going to be as big and strong in Germany soon as it is in the UK.
Well, hopefully.
Jorn, what sort of purposes are these facilities used for? When do funds use them? What sort of circumstances?
Yeah, so we realized about 2018-19 that we really need this facility to be competitive. The reason for that is that, as I mentioned, we are invested in the Mittelstand. We used debt financing. Quite often you talk to mutual banks like the Sparkassen, Raiffeisen, Landesbanken, etc., and they're slow. And you needed to make sure that you get to the signing with a complete financing consisting of equity and debt. So we thought this is the perfect way to pre-finance our debt facilities. And making sure we get the Sparkassen on board in a way that we have enough time, and therefore we used those capital lines. I would say we were early majority. So a lot of funds had it already. A lot of funds could do all equity deals. And when we talked in 2019 to Silicon Valley Bank back then, we were probably one of 10, 15 funds back then. And since then, we've been very happy. We're using that for each investment, but mostly, as I said, for debt financing. So we are not that fund that is doing a capital call once or twice a year, combining all the capital calls and pre-financing them with the fund level financing. We don't do that. We just purely use that for transactions. But that's, again, used at least twice a year.
So it's an equity bridge in the true sense?
Absolutely.
Equity to debt bridge?
Yes, absolutely.
I see.
And to Dirk-Peter's point, our lawyers told us you should really make sure to repay that debt facility within best is 3 to 6 months, 12 months at the latest. Otherwise, you have these tax complications, and therefore it's really used in the best way to make sure the Sparkasse is almost there, then you pre-finance it, and then in 3 months' time you can prepay them.
That works quite well in that situation because your debt financing may not quite be ready, but the extra 3 months that buys you enables you to negotiate it a bit more slowly and a bit more fully. They're very convenient in that case. I can see that.
Competition, of course, is now these debt funds coming into the markets. They're very speedy. So for those, you don't need to pre-finance that.
Yes.
But again, those mutual banks have very good covenant structures, have quite low margin grids. So we prefer to really work with them still.
And Dirk, just tipping back to you, one of the things that Jon just said was that he'd been advised, you'd advised him, I think, that he needed to repay this facility within 3 months to avoid these German tax implications. If a fund wanted to put one of these facilities in place and use it for sort of day-to-day working capital, including buying investments, making investments, and they cleaned it down, as in drew from their investors and paid it back down to zero every 3 months. Do you think, I don't want to put you on the spot too much here, but would funds be comfortable with that from a tax perspective, do you think?
I think they are. I mean, first of all, the requirement is, from a tax perspective, that the respective loan is taken out for short term, and the discussion start what is actually a short term. 3 months, as you said, 6 months, but we also have more aggressive approaches with 364 days.
Yes.
And I think actually many funds use those 364 days. But and then, of course, the situation is also slightly different, because you don't have to make drawdowns every 3 months. But in principle, as you just suggested, yes, of course, they could use it also as a line that goes up and down. Yeah, absolutely.
So from that perspective, I can see it might just be from a fund's perspective, just quite a nice sort of smoothing tool to not to have to keep calling on investors every couple of weeks, 3 weeks, to pay smaller amounts of money.
Absolutely. I mean, Jörn just mentioned that they may make 2 drawdowns under their facilities, but we also have or see a lot of VC funds, and they make a lot of acquisitions, and actually also their investors are happy if they only get 1 call every quarter rather than to have various calls during the months. Yeah, so that makes perfectly sense to them, and it also makes sense to the investors as well. Yeah.
Yes, I can see that. Mirza, I was going to come to you next, and I think I was going to ask you about when during a fund's life would these kind of subscription line facilities typically be used, and also in terms of what you're seeing, not just in Germany but in Europe sort of more generally, and has that changed at all over the last few years?
Yes, I think we are providing capital call lines to clients in the UK, Nordics, Germany, or the DACH region, and what we have seen is, or typically what we advise our clients is to actually have conversations before they start the fund formation process or during the fund formation process, because effectively anything with regards to borrowings is governed by the limited partnership agreement. And this is driving how much debt we can provide to our clients. So really this is the starting point of our conversations, to structure the right facility at that point in time. And then from that point on, as fundraise kicks off, that's when we have those conversations. And I would say in the last years, where fundraise was probably better than today, we would provide those facilities very, very early, maybe at first close, just because there was a very, very strong visibility that target fund size will be achieved and all the other commitments will come in within a very short period of time today we definitely see a very different market dynamic. Fundraise momentum is more challenging, and we still have those conversations. We still provide our clients with commercial terms, but effectively the facility is being put in place probably more at a later stage in terms of fundraise.
And that's because, or is that because, given that the recourse of the lenders is to the investors,
Correct.
In days gone by when fundraising was much faster, the various fund closes would happen more quickly, closer to each other. Probably the first close would be bigger with more investors in
Exactly.
it, but the lender would know that there were going to be, you were going to go from 5 investors to 15 to 40 or whatever it was quite quickly. There's less visibility on that these days.
Exactly.
So the lender's a bit more nervous because
Exactly.
they don't really fancy ending up in the position of the 5 investors at first close. That's why that's taking more time.
Exactly, and this is driving the kind of like the momentum in this market. Like, when do you provide a facility on one hand, providing it early enough to give the client the ability to start investing whilst they are fundraising.
Yes.
At the same time, from a lender perspective, you also have to protect yourself, because if the first close consists of 3-4 LPs, it is very difficult to then anticipate how the future closes will look like, how LP composition will look like, what is the quality of the underlying investor base. Is it going to be 80% re-ups from previous funds? Is it going to change significantly? All those dynamics are today probably more challenging than a few years ago.
Yes. I'll probably use that not now, but in a moment, as an introduction to another kind of fund financing that we call net asset value facilities. But something else I wanted to just speak to Dirk about again, picking your brains from a German tax perspective. If you have German tax issues that you have to work around quite carefully if you're borrowing at fund level, why not form a subsidiary under the fund, an SPV, whose only job is to be a borrower, have that be the borrower of the financing, have the fund guarantee it, and give security over its uncalled capital, just like it was if the fund itself was the borrower? Does that work?
Ultimately, it works. The structure is unfortunately a bit more complicated, because under this pronouncement of the German Ministry of Finance that I already mentioned beforehand, the fund itself cannot grant security for any financial obligations of its subsidiary. And for the lender, it is important to take security over the capital commitments. So the question is, how do you get actually security over the capital commitments if the subsidiary takes out the financing and the security or the assets over which the security should be granted are on a different level? But there are techniques to solve this. The typical solution that you see, but it's actually quite complicated, is that in the first instance, the fund grants or gives an equity commitment letter to its subsidiary. The obligations under this equity commitment letter are secured by the capital commitments, so they do not directly secure the obligations with the lender. And then the subsidiary assigns on all its rights and claims under the equity commitment letter. And by this, then also the security of the capital commitments follows, and then ultimately also they end up at the lender. But it's a more complicated structure here.
I can see that. You've sort of got security and then security over security.
Correct.
I see. And that's presumably a well enough trodden structure to use for German fund financing, that it is used. It
is used, though I have to say, actually, most transactions, the borrowings are actually made directly to the fund, because it's actually simpler. And I mean, all these issues arise as, let's say, this pronouncement that I was referring to various times now is a bit unclear. What is short term, what actually means bridging. But as I said, now Fund Council, they have become comfortable with this. They know what clause they need to include, and therefore I see the vast majority of transactions are financing directly to the fund, rather than having this more complicated structure that you just mentioned. On the capital call facility side, I have to say.
Yes, that makes sense. Just don't borrow for too long.
Yeah, exactly.
I wanted to talk a little bit next about what I call net asset value facilities, which are essentially facilities. I'll sidestep the question of who the borrower might be for now, but facilities where the recourse of the lender is to the pool of assets of the fund as opposed to the uncalled commitments of the fund. And one of the first things that therefore crosses people's minds is for subscription line financing, it doesn't matter very much what the fund invests in. It doesn't really matter whether it's private equity or at the other extreme, indeed, a debt fund, because the recourse is to it's all about who are the investors, are they going to be good for the money? Once you start lending against a pool of underlying assets, then it does make a difference. And you'll get different lenders that will and will not finance different pools of assets. You'll get some that will do PE and some that will not. But they might do infrastructure or real estate or a pool of loan assets. I see NAV facilities very often done, to come back to this point, at an SPV level underneath the fund. Structurally, in the UK, that is usually done because there's also a subline at fund level, and neither set of lenders want a competing lender at the same level. So the NAV facility is put in place at an SPV level. That SPV either itself is in between the fund and that pool of assets, or can one way or another have access to that pool of assets. We've seen quite an increase in the number of NAV facilities. I think partly, Mirza, to come back to what you were saying about the delays in fundraising, as a fund is taking more time to raise its successor fund, it's still therefore got the assets from the previous fund. One of the problems has been valuations, and are you selling at the right price, and people don't know if they're buying at the right price, so it takes longer to sell things. So funds are not tearing through from Fund 2 to Fund 3 in 5 or 6 years. They're definitely taking longer, and therefore they have the pool of assets that they're not able to get rid of quite so quickly at the price they want. They may well have follow-on needs for those investments. They're sort of a bit lower on uncalled capital because a lot of it's been spent already on buying these assets. And so that's where I see NAV facilities coming in. But partly a function of that delay in new fundraising. What sort of circumstances do you see them being used, other than the one I've just mentioned?
I think it's exactly what you said. So I think the core of the issue is really the dried up M&A market, which is not allowing funds to exit according to their original plan, which means that effectively the investors don't have the liquidity to provide additional liquidity for the follow-on fund. And in the end, the managers are sitting on a well-performing pool of assets that are performing well. They would love to exit them, but valuations are where they are. And at the same time, they don't have the capital to use from their investors. So in the end, they need to use other sources of funding in order to think about value accretive strategies during this period of time. And that's where we discuss NAV facilities with our clients, where we see a good pool of assets, well-performing, and in the end, that are different use cases. I would say on the one side, you will see distribution. So effectively, just to kind of like accelerate distributions, going back to investors, and this will obviously help raising new funds. It can also be just additional firepower to invest into follow-on investments, or, and this is probably more specific to HSBC Innovation Banking, being part of the innovation economy, we support venture capital firms who by nature invest into cash burning businesses. So we provide those managers with additional liquidity to invest, because again, the venture capital market is also very challenging, but those clients need additional liquidity to invest into their portfolio companies.
I would argue it's here to stay, actually, because back then, 20 years ago, secondary was perceived as you just do it if you have to, and normally it happened to funds that couldn't continue. And now, and that's the beauty, you have such a big industry around it that you almost have for every problem a solution. We are amazed when people come to us, they look at our portfolio and come with solutions to us already structured with financing around it. So I would argue, because you have those enough facilities, but also a number of continuation fund-focused outfits. They used to be secondary investors. Now they love to do GP-led investments. And for us, it's also a good thing to do if you know an asset very well. And you want to continue, no matter if fundraising works or not. It's just, do you want to do due diligence on a new one, or just
100%.
continue the journey of an existing one? We've done that twice with larger equity providers. We sold to EQT but reinvested, and we sold to 3i and reinvested. But if you do a continuation vehicle or enough, the economics are all yours. So that's the big advantage. And you know the company well. So I would say it's here to stay, and it's just beautiful that our industry now has so many different ways to finance our companies.
I think that's right. There's been a lot of innovation in the space in the last probably 10 years or so. And although we discussed sublines and NAV facilities as being two separate things, and people think of them as separate because one has recourse to uncalled capital, one has some sort of recourse to the assets or the proceeds coming off the assets. Of course, it is entirely possible to combine those two features and produce what not very imaginatively are called hybrid facilities. So, as Jorn was saying, if you have a particular set of assets or you're in a particular situation, you will find lenders out there willing to take a bit of uncalled capital support, take some asset risk if it's a pool. It can even be quite a small pool, in fact. It doesn't need to be 20 PE assets or 200 loans for a debt fund. It can be a much smaller number. It can in some circumstances be a single asset. But combining those different areas of recourse means that almost any product can be put together. And you've mentioned this as well as alternative lenders coming into the LevFin space and moving more quickly and perhaps removing the need for a subline because they can move faster than some other banks can. Alternative lenders themselves very often will come up with and propose these kind of solutions, as well, of course, of needing these solutions themselves for their own portfolio. So they are both users of fund finance and providers of it in almost any shape and form. Dirk, I'm very conscious again that there might be German issues around NAV facilities, as we were just discussing. Do they come up? Is it much used in the German market, or maybe not yet?
Not yet, I would say. I mean, of course, we had various requests, and not so much from PE funds, but from real estate funds, infrastructure funds, where also the structure is maybe a bit easier because this pronouncement by the German Ministry of Finance doesn't apply. But I think actually this is a product that will be very, very interesting now in the next month and years. So hopefully we see enough facilities also in the German market as well.
Yes, I would hope so too. Just moving slightly to another product that we see, and I don't know how prevalent this is over here, what I call GP support or co-invest facilities. And this is a bit different to the other two facilities we've just been talking about. These are facilities provided to the general partner or the manager, or the co-invest vehicle of a fund. I mean, a fund, I'm not a fund formation lawyer, but my understanding of funds is the investors usually want the manager, the sponsor, to have some skin in the game. So they will say, I'll put 2%, 5%, whatever it is, into alongside you into every investment that's being made, and that's done very often through a co-investment, a manager, GP sponsor co-investment vehicle, and the individual human beings behind that, the manager, the sponsors, money coming in, they don't always have that cash on hand, they don't always have that cash available. And it is possible to find lenders to lend to that vehicle with recourse to various things, in my experience, usually with recourse to that co-investment 5% strip. Although that's not particularly liquid, of course. Who wants to buy a 5% strip that isn't mature yet? But usually the recourse is to the management fee stream that comes up sooner or later to the manager, the sponsor. It might not go there directly, but it gets there, because management fees, of course, are paid usually every 6 months in a fairly predictable, known amount. And indeed, once you get past Fund 1 and you're into Fund 2 and maybe Fund 3, you probably aren't going to have more than 3 on the go at once. But once you've got a couple or 3 of funds, you'll have management flows from each of them. Is that something that you see you need, Jorn? I'll start with you. Do you use it?
Not really, not to that point.
Is that financing that HIB does? Yes, we see a lot of that in the UK. Essentially the same theme as the LP. I mean, if there's a lack of distribution coming back to your investors, there's a lack of liquidity. So when you raise the next fund, we do have conversations with our clients who need a financing solution in order to provide that GP commitment. And that's where we typically structure facilities alongside a capital call line. And in the end, it's all driven by management fees. I mean, there are always additional features to get. It's more comfort. I wouldn't say we would ever rely on the carry. No. The actual underwriting is based on management fees, and the more obvious the track record of the manager is, the easier it is for us to underwrite a deal, because there's evidence of growing management fees, and it's also obviously providing comfort for future fundraise.
Dirk, do you see these much?
I mean, we've been working on various GP facilities. I have to admit, they ultimately didn't complete. But we've been working on those from a German law perspective. That's possible. Of course, you always have to look at the particular structures so that it actually also works. But in principle, I think that's also an attractive product for sponsors. And I don't see if in all other countries it's used, why it shouldn't be used also here in Germany. Yeah.
Okay.
And we did have several parties offering it to us, but so far we haven't done it. Maybe we're too conservative. Again, at the end of the day, we have private equity, and debt is all around you. You get to be careful not to do too much, put too much debt on every level. If everything is going according to plan, that's perfect, right?
Yes.
And people anticipate, well, we're going to double the fund, triple the fund, all good. But who knows what's going to happen in the next 5-6 years? And if something happens, you have quite an effect. If your portfolio has a significant amount of debt, you have a GP level of debt, you have a fund level of debt, and then the whole economy tanks.
Yes.
So it's certainly subjective, and maybe at some point we warm up to it.
It's yes, not every fund that I know that has cap calls or NAV facilities, or has had both, has them, but many do, I think, in my bit of the world. That was about it from my side, I think. Was there anything else that any of you have by way of sort of general observations about the market, where it's heading, or how it is going to be? In what are your predictions in Germany in the next 5 years? Dirk, we'll start with you.
Well, that's a tough question. I mean, I think if we talk about capital call facilities, it's a huge disadvantage for German funds if they don't make use of it. Yeah, so I think they will make use of it, and I also think that the other products will come into the market and will be used more frequently in the future. I'm absolutely sure about this. And I mean, the decisive point is in particular whether, also now lenders come into the German market. There are, of course, there's HSBC, but I think, there's even potential for more lenders to offer those products. And I think in the long term, this will also be the direction the market will heading to.
Mirza.
I'm very optimistic about the next 5 years. I think the toolbox is there to provide the right solutions during the fund's life. It's just about probably some teach-in and explaining to the community what those tools provide and how they should be structured in order to really benefit from the advantages.
So more panels like this then?
Absolutely.
Jon.
I absolutely agree. I think fund level financing is the standard now. You really need to have one compared to working capital lines of our portfolio companies. It's just not feasible not to have one. And I'm really curious about additional financing structures and tools and opportunities. So it will be good.
Thank you. I don't know if anyone in the audience has got any questions for us. We were told we didn't have very long to take any questions, but I think we've got a minute or two. If not, then thank you very much for listening.
Thank you.